Hello and welcome back to All Things Money. I'm your host David Blain. During this final segment today, we're continuing our discussion about annuities, trying to get some information out there to possibly counter the onslaught of sales of annuities. There's a lot of misinformation out there. May be right for some people. In our business, the clients that we see come through our door, it's not generally a solution that we would recommend. In fact, I've never recommended one. The fees and lock-in and things like that to us are just not worth the cost. So if you missed the first couple segments, we started with an introduction. We started going through the different fees found in annuities. Head on over to the website, which is dlblain.com, and you can catch up with the show. We were just about to get into the fourth type of cost. So remember, we had disclosed costs, which if you drink a lot of coffee and can stay awake and read through the 5-inch thick prospectus, you can probably find those disclosed costs. And then there are the built-in costs, such as deferred sales charges and commissions and things like that. We talked about the opportunity cost briefly. And the fourth type of cost is the tax cost. Now, we do have a lot of tax expertise, and we advise our clients on it, but tax policy, unfortunately, is very client-specific. As you've probably heard me talk about before, there are multitudes of tax codes out there. If you don't make anything, you're subject to one set of rules where you get money back for nothing. If you're in the middle class, so to speak, there's another set of rules, and if you make a reasonable amount of money, there's a completely different set of rules. So I'm going to give you some generic advice. If you have some questions, let us know or contact your tax advisor. But all annuities purchased after 1982 are what's called LIFO, which is last in, first out, meaning that taxation applies to all the gains taxed first at ordinary income levels. Now this is first of all, you should never put an annuity inside an IRA. Let's just say that. If you have an IRA or Roth IRA, don't buy an annuity inside of that. It should be criminal. It's not, but it should be. So if you do that, another set of taxation rules apply. The IRA rules apply. So when you take that money out, it's all ordinary income, just like withdrawing from an IRA. If you have a non-qualified annuity, then it's taxed all the gains first and then the principal. If you actually annuitize that annuity, you have what's called the exclusion ratio, and a ratio of each payment. Part of it is interest and part of it is return of principal. If you take it out before age 59 and a half, the penalty applies unless you have some sort of 72T, which is way too complicated for the show to go into. But you have to be very careful with the taxation of these things, getting them out in a tax-efficient manner. They're very difficult to get out in a tax-efficient manner. All right, we've got a few minutes left for this segment. I just want to run through briefly some of the types of annuities. Actually, there's so many different types. Maybe we'll catch up on that next week, because I want to hit on a few things, some considerations when looking at annuity. If you're talking to someone, remember, a lot of agents out there, or financial advisors, as they're so-called, specialize in one type of annuity. And this is one of the things that just drives me crazy, is they use these annuities like a big hammer. Any of you all that do any work around the house or anything, you've got that one big hammer and you've got that one big adjustable wrench, and you can fix just about anything with those two things. But if you actually hire a plumber or a carpenter or something, they're going to come in with a whole bunch of tools in their toolbox. Well, a lot of annuity salespeople, they use that one annuity that's the hottest selling thing, is that big hammer. And everybody that walks through the door, that is the solution that they need. So if you're thinking about annuity, make sure that you outline your specific problem. Is it a death benefit? Is it a guaranteed stream of income? Is it principal guarantee? Is it to leave an inheritance? Is it long-term care? Make sure that you have an opportunity to explain what you're looking for, and don't don't get hit with the big hammer of the hottest selling annuity of the day. There are a few other issues that I want you to be aware of. First of all, the currently low interest rates. Now, you've heard me talk about this on the show before. Nobody knows the direction of interest rates. Ask the people in Japan who've had extremely low interest rates for a long, long time. We don't know that interest rates are going up, but you need to understand how your annuity, especially if it's a fixed annuity, how it's going to react to rising interest rates. If you're locked into your payments, see, most of the payments are set based on the 10-year Treasury, and so at a low interest rate today, the payment is going to be very modest. And so if you lock yourself into some sort of income for life thing at a 2.5% Treasury yield, you're going to be in a world of hurt if you live for another 20 years and inflation and interest rates spike up. So you want to make sure you understand, nobody knows the direction of interest rates for sure or when, but you want to understand how that thing is going to react to a rise in interest rate. The other thing I'm going to touch on that you don't hear a lot about is that in less than 2 years, over 30% of fixed index annuities are now owned by hedge funds and private equity firms like Guggenheim, Apollo, Harbinger, etc. The top selling fixed index annuity in the country in 2012 and 2013 is hedge fund owned. Now, I'm not going to say if this is good or bad. It's just something that at doing your due diligence on these things, you need to understand what are the implications of a hedge fund owned annuity. And you should also in the back of your mind be saying, okay, why is the hedge fund selling me this? But it's something that we need. It's a relatively new development. Hedge funds moving in this space in a massive direction. You need to be aware of it, and you need to ask those questions. And then the last thing, if you're trading the risk and the guarantee to an insurance company, you need to make sure that that insurance company is going to be around. Yes, there are provisions if insurers go under, but you want to make sure about that carrier safety. There's something called a Comdex rating that you can look up in addition to the financial strength ratings of different annuity carriers. So you want to make sure, if you're placing your trust in some fly-by-night annuity company, just be warned. Well, that's a good overview of annuities. Maybe next week we'll have time to go into the specific types of annuities that are out there. Well, I hope you enjoyed the show, and we'll see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.